A capitulation event, we define it as a situation where other investors are selling for what we believe to be emotional rather than rational reasons. This is the kind of capitulation event kind of journey that you might get, which is...
I've seen this movie. They have they have 3 profit warnings, don't they?
Exactly. It was in 3s, yeah.
The following is for information purposes only and should not be used as the basis of an investment decision. This is not investment advice. This episode is made possible by Progressive Equity Research, providing freely available, engaging investment research and opportunities to hear from a wide range of small and mid-cap UK-listed companies. Back in March this year, David Seaman of Alpha Cygni Asset Management joined me for a conversation with Adam Rackley, the founder and fund manager at Cape Wrath Capital. Adam epitomises the philosophy of doing things differently when it comes to investing in UK equities. He has pursued his unique approach since founding Cape Wrath in 2016, using what he describes as a behavioural value strategy. He looks to identify market capitulation events and narrative shifts, to cycle capital into shares when they are driven by emotion more than rationality. He then looks to exit positions when the narrative shifts, leads to equity revaluations to his appraised fair value. Adam runs his fund according to what he calls the rules of Wrath, not the established conventional rules of thumb that seek quality companies and long-term holding periods that try to avoid volatility. No, for Adam, it is a marketing strategy designed specifically to discourage investors who can't stomach the journey into the deep value that exists in the UK market. He wants a band of loyal investors who understand and back his strategy, a strategy he is fully committed to and invested in. While he has all the credentials of a conventional equity fund manager, Adam is anything but. Previously an army officer, Adam has degrees in PPE and law and the CFA qualification. He has also rode the Atlantic, written the books on the Channel, cycled from Land's End to John O'Groats and lived and worked in India for several years. And he is now based in North Wales. According to Morningstar, last year, only one of 72 smaller companies funds outperformed the UK Smaller Companies Index. That fund was Cape Wrath. A one-year wonder? Well, not exactly. As of the end of May this year, Cape Wrath has significantly outperformed its benchmarks over 1 month, 6 months, 1 year and 5 years by sticking to and evolving its rigorous investment strategy and process. This is a fascinating conversation in which Adam delves into some examples of how his strategy has played out and how he hopes to develop his process further. He then looks forward to the day he can close the fund to new investors, switching off his LinkedIn account and retiring to his library to do what he enjoys best, picking undervalued shares. Please enjoy our conversation with the maverick investor, Adam Rackley.
Brought to you by Progressive Equity.
Morning, Adam, and thanks for joining us today. Can you start just by telling us about your background and your journey to starting Cape Wrath Capital?
I started off on a graduate training program with an investment trust business up in Scotland. And then I moved down to a UK and European small cap equity firm in London, where I learned a great deal over my kind of 4 or 5 years there. Towards the end of that time, I kind of got itchy feet. I had a bucket list of things I wanted to do, and I took a sabbatical, a long sabbatical, about 4 or 5 years. I wrote a book. My wife and I moved to India for a bit, where I worked for an equity research firm over there, which was it was a fantastic, immersive experience. And then came back to London in 2015 and set up Cape Wrath Capital, and we launched the fund in 2016. So it's been up and running for close to 8 years now.
In that sabbatical, I think you also rode the Atlantic. Is that when you did that?
Yeah, that's right. I rode the Atlantic when was it? Beginning of 2010. Yeah. A friend and I spent 11 weeks together, naked for the most part in a little boat, rowing across the Atlantic from the Canary Islands to Antigua. The experience was not how we expected it to be, but it was certainly the toughest thing I've ever done.
So that was 11 weeks.
11 weeks, yeah.
With one other person in a boat, rowing for 2 hours, sleeping for 2 hours.
That's right, yeah. So you're doing a 2-hour shift.
Rinse and
24
repeat.
hours. Exactly. 24 hours a day, 2 hours on, 2 hours off until you get to the other side, basically.
So if you look at your CV, you studied PPE, you're in the army, you did a degree in law.
I did a master's, a kind of part-time law master's, while I was
You're
working.
a CFA. As far as that goes, it reeks of city convention. But if you dig a bit deeper, there's a lot of other stuff going on here. So where did you get this sort of sense of being different and this sense of adventure that you've clearly got?
I mean, for me, the army was probably the start of it. So the two things I have in common with the greatest prime minister we never had, Rory Stewart, is we both served with a Scottish infantry regiment called the Black Watch, which doesn't exist anymore. And we both served on this weird and wonderful scheme called the SSLC. The normal route to becoming an army officer is in your final year at uni, you go off to something called the Regular Commissions Board, the RCB, and it's like a 3-day boot camp. And then if you pass it, then you go off to Sandhurst. But the SSLC scheme, you were selected in your final year at school. So you're kind of 17 years old and you go off and you do the RCB and you end up, if you get a place, you end up going to Sandhurst. But the real genius of it, and maybe the reason why it doesn't exist anymore, is that obviously at 17, 18, you're at kind of, peak know-it-all. And so rather than sending you there for a year, they only send you there for 5 weeks. So you go off to Sandhurst for 5 weeks and you emerge not knowing what you don't know, not even starting to know what you don't know. And you get sent off to lead a platoon of, 30 trained killers, basically. And that for me was a huge adventure, just a real character challenge and a real step outside of the comfort zone.
Coming back to Cape Wrath, how would you describe your investment strategy?
I describe our investment strategy as a behavioural value strategy. And we are looking to profit from other people's mistakes. I think that the strategy lends itself to somebody who perhaps likes to see things differently, a kind of contrarian attitude, somebody who likes to question everything, really question the kind of first principles. I spent the early part of my investment career with a quality growth firm, so almost the opposite of the existing investment strategy. And it was a great firm. They did things the right way, and I learned a great deal there. But the strategy didn't chime with my personality. And I think, for you to have longevity and for you to really feel like you're getting that hierarchy of needs, getting your kind of self-actualization from your day job, and the two need to be aligned. And so that's what led me to set up Cape Wrath.
Your personal journey then, and that self-awareness that you need with finding the right strategy for you, you could almost describe it as the inverse of Buffett's own evolution. It's interesting that despite then your process now being clearly defined on the behavioral value side, you seem very well versed with the more conventional quality growth, or more popular, should we say, quality growth process.
Yeah. I am a Buffett fan. I've been to Omaha and, got the table at Piccolino's and drunk the Kool-Aid, or at least the root beer float, all the rest of it. So, I think any investment strategy, if thought through well and applied with vigor, can deliver good returns. But which particular strategy you choose is down to your personality type. So, I think on the journey, you begin by understanding what everyone else has done and, reading all the books, and then you kind of start there and find your route through. You can try and fool yourself, but it'll catch you out in the end.
If you try and emulate somebody else, that almost by definition means you don't have the sufficient conviction to be able to hold your nerve. And particularly with your strategy, I'm sure we'll come on and talk about how you implement it day to day, but you need to be able to hold your nerve.
Absolutely, yeah. I mean, that is key. We often end up fighting against momentum initially, and so that leads you to question. And that's the point at which you've got to know that you've done the work and believe in your thesis.
So as well as having the right investment strategy for your personality, which I think is a general truth, right, that we can all take on board, you do seem to have taken it to quite a degree, including where you're based. Would you mind sharing the process that you went to that led you to where you currently are physically?
Yeah, sure. Yeah. So my family and I live in North Wales, just on the edge of Snowdonia. And we were living in London up until kind of 2018. But we wanted to live somewhere that would allow us to have a better lifestyle, basically, I think, once we'd had kids. And so I'm keen on the mountains, climbing in the mountains, running in the mountains. My wife's keen on the sea. And so we just got a map of the UK and just started putting pins in the map and visiting places and overlaying that with the kind of the list of places that hadn't voted for Brexit and put it all together. And this is where we ended up, North Wales. You make a few important decisions in life that you want to really get right. But there's a lot of stuff that you can kind of chill about, and it's kind of water under the bridge.
Particularly interested in the balance between being remote in terms of perhaps allowing you a greater degree of objectivity about the investments that you're making, but balancing against the need to execute the strategy. And something I'm curious about, given, as you describe, you want to participate in capitulation events, and we'll get on to defining how you view those. But it seems to me these may be pulling in opposite directions, i.e., you might need to be closer to the market to successfully execute the strategy.
I mean, I think a capitulation event, we define it as a situation where other investors are selling for what we believe to be emotional rather than rational reasons. So you might have a stock that's down 80% from its 2-year highs, and the managers who've had it in their portfolio for that amount of time are feeling a lot of pain in it. It's probably become a de minimis part of the portfolio because of that share price decline. It's probably gone from being a well-regarded company to one that's kind of seen as a dog effectively, and so the PM's probably facing lots of awkward questions from their own investors about it, and it's probably just taking up more emotional bandwidth than it's worth in terms of the potential return that the PM is likely to get from that kind of de minimis position. And so we look for those types of situations on the basis that an exit may well be a kind of exit at any price to get rid of the pain of holding that position, just clear it out the portfolio. And for the PM in question, that could be absolutely the right decision to do, to kind of clear the position, clear their mind, allow them to spend that emotional energy on something that's going to make them better returns. But for us, it can lead to a very profitable entry point. We're looking to identify the capitulation events kind of on the way in, and then this opportunity for a narrative shift to drive the re-rating on the way out. You talk to a lot of PMs, and a lot of what they do is around, meeting management teams. That's core to a lot of people's processes. And a lot of people will get a lot out of walking down the street, bumping into peers, bumping into other people in the city and the network, sharing their stories about the companies they've met and all these kind of elements. And I think for a lot of people, that's a really big part of the job and that kind of information. And that's certainly one way to think about collecting narratives and understanding narratives. The way I think about narratives is the way I think about creating a story, a novel. You take your dozen characters, you set them up with a motivation and a scenario, and then you let them run, and that kind of creates the narratives, and they bump into each other and all the rest of it, and that creates your story. And so I think that for me, understanding the kind of market narrative is as much an exercise in open-mindedness and empathy. It's an exercise in empathy rather than an exercise in going out and actually physically meeting the people in the street and chatting about this stock and that stock. So for me, it sounds completely kind of counterintuitive, but it's a desk-based approach, absorbing all of the information that's out there. And we spend a huge amount of time absorbing information and then applying empathy the same way I would have empathy of a character I was creating for a story, and then understanding how that unwinds.
Can you talk a bit about how you go about identifying when that narrative might be shifting or about to shift?
With a capitulation event, often what you get is a turnover in the shareholder base. And so for us, that can set a new base for the stock. You get the old investor base who had certain expectations, much higher expectations of what this company could achieve. They exit and are replaced by a new investor base that has a newly reset set of expectations of what the company can achieve. And that often creates the basis for a narrative shift, because the share prices are essentially driven by companies outperforming or underperforming versus the market's expectations of them. And so if you can have extremely low expectations of the business, or a shareholder base with very low expectations of the business, then you are tilting the table in your favor. It's also about just trying to peel the emotion out of it, try and look through cycles. So when we're building our financial models, we'll typically use 7 to 10 years of historic financial data, so we can kind of look back through the kind of longer history, understand what might be cyclical versus what might be structural, and what the normalized earnings could be. So that helps us to understand in a purely kind of quantitative sense what the opportunity and the upside is if and when the narrative turns.
The risk that the narrative doesn't change in the way you might like, you would just move on. In that situation, you have to make an assessment just to move on to something else then.
There doesn't always have to be an immediate catalyst. So we will have an idea of how the narrative could evolve. But as long as it's not a value trap, and by value trap, I mean a company that is getting cheaper and may go to zero, then we're happy to hold on to it. I mean, our ideal scenario is one where the catalyst is realized in the short term and we achieve a higher IRR effectively by hitting our fair value in a shorter time frame rather than a longer time frame. But if we don't hit it in a short time frame and nothing changes around our thesis and our fair value is robust, and we update our fair values regularly, then we're happy to continue holding it.
The language that I've seen you use to describe buying capitulation is doing what feels hard but that is ultimately right. Why, in your experience, is this so hard for investors of all kinds to do?
Well, I think we all look for some kind of social proof, and the market gives you a social proof by sending positive momentum or negative momentum. So if you're buying something that's down 80% from a recent peak, then you're buying against that social proof, against what the market's telling you. It can make an emotionally difficult decision.
You wrote down the rules of wrath versus the rules of thumb, which I thought was really interesting in terms of overturning some of the nostrums and things that most investors run out on occasions like this. We only invest in good quality businesses, and maybe it'd be helpful to articulate how your rules, how you run against some of the generally accepted rules of thumb.
For compliance reasons, we write all this thought stuff and we call it non-promotional material. And really, this is an anti-promotional material because, we're basically explaining to people why they shouldn't invest in our fund. I guess the origins of this kind of approach really started very early when we started trying to market the strategy. I mean, what I realized quite early on is it's a kind of Marmite, basically. There's a lot of people, most people maybe, it just won't make sense to them. It won't click with them. And so those people, if they do invest, they're going to become confused and disillusioned quite early in the journey because there is a lot of volatility in our performance. Long-term numbers are good, but there's a lot of short-term volatility. We just want to set out our stall, and the small number of people for whom it clicks are going to become fans and they're going to invest. And the other people, it's better that they know straight away that this isn't for them than they think, oh, it sounds great. And, they invest and they're like, wait a sec, what's going on here? This isn't what I thought. Oh, the top 10. Why is he holding these companies? And it's just bad for everyone. So our kind of approach to marketing has always been to try and put people off as much as to attract people to the fund, because we just want to make it, clear what we're doing and no confusion. And it all feeds into that kind of classic Warren Buffett type approach. You find the best quality companies you can and you hold them forever. And that is one great way to invest, but it's not the only way to invest, is our point. And so, in terms of buying quality is an important factor in terms of determining the fair value of a company and also the risks that you're taking when you're buying that business. But quality is not the problem that we are solving for. We're looking for companies that are going to generate the best risk-adjusted returns, and quality is only one kind of element in that. And related to that is holding periods. So I think many people, when they're thinking about investing, think about it from a kind of quality growth perspective. With a quality growth perspective, you make one great decision, and then if that decision is correct, as in you bought this fantastic long-term growth business, then you never have to sell it. Your ideal holding period is forever. It's like kind of, Nick Train sitting in his library making one investment decision every 3 years or something like that. In that scenario, you buy quality, you hold it forever, and that works. But in our scenario, we're not looking to generate investment returns by the long-term compounded returns of the underlying holding. We're looking to generate investment returns by benefiting from the re-rating and then taking our returns and reinvesting those in another stock. It's a much faster moving flywheel. And so our favorite holding period isn't forever. Ideally, it's as short as possible. It's whatever holding period we need in order to realize the catalyst or the return. But if it's shorter, then we're going to generate better returns ultimately for our investors through faster compounding of those returns. And then another outcome of this approach is that it's going to be more volatile than many other funds, more volatile than the market. I had a friend, a former colleague, and he invests in some interesting single name equities, and he also invests in the Cape Wrath fund. And he called me up one day and he said, I've got all this funky stuff in my portfolio, but the most volatile thing there isn't the stock, it's actually your fund. If you want to generate differentiated long-term returns, I think that it can be helpful if you're happy to stomach short-term volatility.
Can you just talk about what your day-to-day process involves? And let's also talk about the structure of your portfolio, because you have quite a small number of holdings in the fund.
So our process involves myself and Anders, who I work with on the research side. It takes about a fortnight, I would say, to do a deep dive on a stock. And we work really hand in glove. So we've both worked at firms in the past where you have a large, well-qualified research team who work alongside the PMs, but the PMs use these analysts as one amongst sort of a whole variety of external resources. And, arguably, the analysts are not used to the best of their ability or potential. And so Anders and I were keen to avoid that. So the way we've structured it, every idea is worked on by both of us in hand. And we each focus on the areas where we have the best skill set. So Anders, who's got a lot more experience than me, focuses on the kind of business analysis piece. I focus on the investment analysis. I do the accounting analysis. That's the specialty of mine. I'm more comfortable at making uncertainty decisions under risk, which is what managing a portfolio really is. So ultimately, I make the kind of final investment decision and pull together the thesis. But we kind of work hand in glove. The process begins by generating a list of new ideas, which can come from a variety of sources. So we use screens. We use the network, so friends, former colleagues in the industry. I might get a call from someone who says, I know so-and-so is feeling a lot of pain on this and they're chucking it all out of their portfolio. Might be worth you looking at it. And once we've got a basket of new ideas, it's roughly a kind of monthly kind of cadence to the research process. We might get half a dozen new ideas on a monthly basis. And as we'll run them through what we call a red flag evaluation, which might take half a day per stock. And it's like a streamlined version of our investment process. And really, what we're trying to do there is to throw out the likely value traps before we spend too much time working on them and creating that kind of potential commitment bias and opportunity cost. From that half a dozen initial ideas, we might get 2 or 3 get through the red flag evaluation. And as will enter usually 7 years of historic financial data manually into the model. We could take a kind of an Icon or a Bloomberg data download, but we find that we don't trust the resilience of the data. We don't know what adjustments have been made to it. And if Anders does it manually and we talk through any adjustments, then we can be confident. I can be confident when I'm using that as a basis for ratio analysis and forecasting that the data is robust. At the same time, Anders will prepare a news flow analysis. So we do a long-term and a short-term news flow analysis, long-term being over a cycle, short-term being since the share price started to decline. And this is the beginning of our behavioural piece, if you like. So this kind of annotated share price chart gives us a sense of what has been moving the share price over those periods. And so I'll make use of the work that Anders has done to start to do some ratio analysis to build up the valuation. And the kind of final stage is to pull it all together into our note, our initiation document, where Anders focuses on the business analysis, I focus on the investment analysis, the evaluation, the investment thesis, and the risk and return, the position sizing, all that kind of thing, and the final decision whether to buy it or to let it reside on our watch list for a future date if the risk return isn't quite right.
Given that you are intentionally walking into what look like pretty hairy situations, the red flag process is particularly interesting. Could you talk a bit about your debt structural decline and complexity filter And something that seems missing, or perhaps you incorporated in one of those, considering governance. So in your experience, what are the things that tend to kill an idea as it goes through that stage of the process?
I think our biggest losers have always been situations where we invested in companies with weak balance sheets or in industries where there's been some kind of rapid change, disruption, or some combination of the two. So a stretched balance sheet in a business which has also got structural issues is typically a recipe for some big losses. And so that's really what we're trying to think about when we're doing the red flag evaluation. There's also a little bit around complexity insofar as, if we look at one Rolls-Royce, then we're not looking at half a dozen smaller companies just because the complexity of the business and the time it takes to get a handle on it. So that's another thing that we'll think about at that stage. In terms of governance, I think you think about kind of management quality, that kind of thing. Only one situation really comes to mind where we started doing a deep dive on a company and it was attractive from a valuation perspective. And, we could see the capitulation event, but management just didn't pass the sniff test. Actually, the company ultimately went bust. But I'd say that evaluating management, as long as they don't appear to be dodgy, it's not a core part of our process. I'm sure you guys have all read The Outsiders and, what makes great management teams, great capital allocators. And I think, again, if you're a quality growth investor and you're kind of getting into bed with this management team for the next decade, Warren Buffett gives that example of how, if management's taking 10% of the capital and reallocating it every year, then actually over a 10-year period, the capital allocation decisions that they have made account for all the capital that's in the business. So if you've got that long-term investment horizon, then I think it's absolutely critical to back the right rider. But if you're looking more at how the market is reacting and you're thinking more about these narrative shifts, then management quality is less important. Not to say that it's not important, but it's less important.
Somewhat surprised to hear you say that, partly because, in situations where management are under pressure, there are few decisions in the short term around capital allocation. Presumably you make quite a big difference to the path that we go down. In my experience, even people that have a track record of good capital allocation, when they're under the extreme pressure that I imagine may come along with the kind of situations you're discussing, will do what they have to do to survive. And that might mean stay in their jobs or avoid a painful refinance or whatever it might be.
Yeah, I think often the situations we're looking at, there will have been some recently appointed new management in place. And if you think about the kind of classic life cycle of these types, the very rough template that doesn't apply in every scenario or even most scenarios, but you have a company that's done a big acquisition at the wrong point of the cycle, integrated it poorly, balance sheet's been stretched, share price declines significantly as people start to warm up to the idea they're going to have a rights issue. They have a rights issue either before or after they have kind of management change. Maybe they have management change and they have a rights issue. This is the kind of capitulation event kind of journey that you might get, which is...
I've seen this movie. They have they have 3 profit warnings, don't they?
Exactly.
Yeah,
it was in 3s, yeah. And then the new management team, they probably launched the rights issue. They've done their kitchen sinking and that kind of stuff has happened. So typically, this is the point at which we kind of join the story, as it were. So a new strategy has been kind of outlined. The balance sheet has been probably fixed. The sins of old have been laid on the shoulders of the people who are no longer there.
So it's through selection of the capitulation event. Perhaps at this point, would it be useful to use an example to illustrate some of these things? So if you'll allow me to select one from...
Please do.
EnQuest. So you talk about debt, structural decline, complexity. We have at least 2 and maybe 3 of those in this case, yet it's a holding in the fund. Could you talk about the thesis and how it passes these?
Sure.
Might be worth just setting the scene on EnQuest and just giving us a bit of a high-level reminder of
sure. So
what it does.
EnQuest is a UK North Sea focused oil and gas company. They also have some assets in Malaysia. And their strategy is around increased oil recovery from fields that are late in their life. So during the early stages of a field's life, you're typically going to have a growing production profile. Later on in the field's life, you're going to have declining production profile, particularly somewhere like the North Sea, which is a very mature basin. And so their strategy is around taking on these fields, either paying for them or in some cases, essentially getting them for nothing and squeezing out some extra production from them. For EnQuest, the big issue for them kind of historically was basically a hangover from a field called Kraken, where they spent a huge amount of money building a floating production storage and offloading vessel, an FPSO, in order to develop this Kraken field in the North Sea. And they spent more money on it than they should, and the production levels weren't what they thought they would, and the oil price turned, and et cetera, et cetera. And so they ended up with far too much debt. And so the kind of story has been one of them paying down that debt over time and getting from a position where they're very fully invested in terms of their asset base, and as a consequence, were quite loaded in debt, to one where they are now debt's kind of manageable, and the management have started talking about paying a dividend or doing some kind of cash return, which is a big shift from where they were a few years ago. An interesting thing with EnQuest is that the CEO who effectively founded the business, he spun it out as a division from another business a number of years ago. Him and his family own about 15% or so of the company, so he's the biggest shareholder in the firm. So he is kind of absolutely aligned with his investors. He is EnQuest, basically. Amjad is EnQuest. The ESG angle is the big challenge here. So actually it's not overloaded with debt today. So that has changed through the cash flows the company's generated to pay down that debt. At the moment, the company's trading on a free cash flow yield of over 50%. And depending on their capital allocation decisions, could be debt-free in a couple of years.
I think that to me seems the distinctions of debt is still something like 2/3 of the enterprise value. But looking forward a year or two, given the cash flow, they can choose to completely...
Debt's 2/3 of the enterprise value because of how very compressed the equity value has become below, what we think the fair value of that should be, which is many multiples of, where it currently sits. I think that the ESG, the environmental angle, is a key issue here, not because I think that oil is going away anytime soon. I think we all agree and accept that an energy transition needs to happen, but also that it can't happen overnight, and it's a journey to that energy transition and to doing it in a way that if you turn off the taps tomorrow,
civilization ends.
Exactly. Yeah. The key issue is the ESG element, and also how that manifests in government policy. And so the windfall tax is a great example of this in the UK. So the kind of UK North Sea producers have gone from a 40% to a 75% tax rate. And I think that part of the goal behind this was to satisfy public discontent around the likes of Shell and BP making bumper profits, paying huge dividends. Of course, the irony is a lot of those bumper profits and huge dividends were made from the trading side of these businesses and actually had nothing to do with the profits they're making in the North Sea, because these majors have largely pulled out of the North Sea. It's actually kind of affected the kind of smaller E&P companies that are North Sea focused. So that's a key issue. In EnQuest's case, because of the losses associated with the kind of Kraken development, they've got about $2 billion of tax losses. Those tax losses can't be offset against the windfall tax, but they can be offset against the normal North Sea tax rate of 40%. Those $2 billion of tax losses are worth about $800 million. So 600 million pounds, or whatever the exchange rate is, which again is a multiple of the market cap of the business. So they are insulated not from the windfall component of the tax, but they are insulated for many years from the kind of normal tax.
The narrative headwind is also behavioural, because the vast majority of investors who would look at this area of the UK stock market won't be able to look at this stock, presumably because of what it does. You could argue the valuation, although clearly extreme, is what you get with the general adoption of that behavioural policy by the majority of institutional investors.
Yeah, I think you're right. Amongst an institutional investor base, it's difficult to know where the marginal buyer of this stock is, which is what you need to drive the re-rating. I think what we've seen across kind of UK small cap land is a lot of increasing interest from private buyers. So we've had, see, there's, possibly a bid underway for Currys at the moment, which is in the portfolio. We were holders of SCS, so from Carbo Company, which got taken over every day last week. It was the week before, there was some bid in the offing in kind of UK small cap market. So I think that's, another kind of route out of this is somebody who says, well, actually, I'm not so concerned about that angle because I'm just going to take this 50% free cash flow yield.
Yeah. And the tax losses and yeah. It's a wider point. Come and talk more about some of the examples of companies in your portfolio. But essentially, if your strategy works, you rely on mean reverting markets.
Absolutely, yeah.
The price mechanism has to work.
Yeah.
And for large parts of the last few years in the smaller end of the UK stock market, it hasn't been working. And there are these huge anomalies. And I guess one way of solving for that broken market process is for private capital to come in and arbitrage it, which is what we've been seeing.
Yeah.
Or for the operators of the companies to be in a position to realize the value themselves through allocating that free cash flow.
It might have been a hangover from the days of free money, but increasingly what we've seen is is more and more discussion or more and more comment from management teams about capital allocation and increasingly about cash returns to shareholders. And that's, I think, something in the last 6 months or so that I've seen a lot more of in the kind of management commentaries that I've been reading. And that's either one of two things or maybe both. A, the fact that people became kind of sloppy when money was really cheap and they're having to tighten the belts now that money's more expensive, but possibly going to get cheap again. And secondly, the fact that, that the corporate financiers have been whispering their ear about if the market's not going to recognize the value, then you can do this to help yourself by looking at ways in which you can run the business more for cash and return that cash to shareholders to demonstrate the value, buybacks or dividends, special dividends, whatever it might be.
How cheap is the market today? Are there any nets in the UK? Are we at that level of extreme undervaluation?
There are some nets around. I think for us, really, we launched the fund in 2016 and it's been a kind of game of two halves. I think pre-COVID, we found it a really tough market to be a value investor in insofar as we were kind of squeezed into a smaller number of opportunities, a smaller number of sectors. Maybe we had to take more systematic, more macro risk than we wanted to because of the lack of opportunity. Post-COVID, there's been a huge amount of opportunity. The way we should execute this process, this philosophy, is by being kind of agnostic about the macro and focusing on the stock-specific risk. And that's something we're really able to do in this type of market. In terms of nets, plenty around. Yeah, we've kind of always got something in the portfolio. So
can you just explain what a net is?
Yeah, sure. Yeah. So a net is a kind of Ben Graham old school value concept. And to calculate a net, you imagine that you're going to liquidate a business and you're going to do it in the quickest and least efficient way possible by effectively giving away all of the fixed assets. So all the land, all the buildings, all the machinery, all the equipment, you're just going to give that all away. And you're just going to take your current assets, so stuff on the balance sheet that can be converted into cash during the normal course of business, so your accounts receivable, your inventories, and the cash on the balance sheet. So you're basically taking this as your asset base. Then you're deducting from that all of the liabilities. So all of the short-term debt, all of the long-term debt of the business, any lease liabilities. And then what you end up with is this kind of fire sale, real deep fire sale value for the business. And the idea is that if you buy something that cheaply, you've got a great margin of safety. Unless things go catastrophically wrong, it's quite difficult to lose money over a medium-term time frame if you buy something at that kind of value. And so they are kind of
the holy grail of value investing.
Yeah, exactly.
Is it what Warren Buffett called cigar butt investing, I think?
There can be a bit of that depending on the quality of the underlying business. Post-COVID, we see plenty of these things around. There's always something in the portfolio. So if I go back, I mentioned SCS, the specialty sofa retailer. So that when we bought it was a net. That got taken out by an Italian sofa retailer last year. More recently, or probably before that, actually, we had International Design Group, IG Design. So we bought that back in summer 22. The net value on that was 61 pence from memory, but it fell to probably south of 50p. But we bought it at about its net value of 61p. We thought that was worth about £1.50, which is the price we sold it at. It carried on going past that. It's fallen back down since. The most recent addition to the portfolio is Winstay, which is an agricultural supply business. And we had invested in Winstay in the past. It's kind of a classic small company insofar as it's not particularly widely covered by the sell side. And there is an opportunity in that with these undercovered small companies. I mean, with a large company, you're investing in Glaxo, you're not going to know more than the 60 analysts, sell-side analysts out there that are covering kind of Glaxo amongst the maybe 4 other stocks that they're covering. But if you're looking at a company like Winstay, which has really got limited interest from the sell side, there's a house broker covering it, but maybe not very closely, then running your own model as a PM can itself be a source of alpha. And so historically, we've done things like the first half numbers should have led to an upgrade, but they didn't. And so we could see that there was an upgrade baked in for the second half. And, you buy it and wait for the upgrade and you make a nice return on that. But more recently, we bought it because it came across our screens as a net. So we worked out it was worth, or the net value was something like £3.30, which is where we started taking a position. And then we work out, what the fair value is. And in the case of, Winstay, we see probably 60% upside from current levels, what we believe is a fair value.
You end up with a pretty tight list of companies. How do you think about diversification?
So we've got about 25 holdings in the portfolio today. And we have, during the bad old days, say 2018, we got down to 8 holdings and 45% cash, which for a UK onshore regulated fund is a very unusual position to be in. So, for anyone listening who's not familiar, most of our peers would probably hold 60 to 80 holdings, maybe more in some cases. So for us, 25 is a pretty full portfolio. The challenge, if you're running a fund, is that you can't go 100% to cash when you feel that the opportunity set has tightened up. And, 45% cash was a pretty sticky situation to be in terms of our ACD breathing down our neck and claiming us in technical breach of our prospectus. And investors obviously are not going to give you any more cash if you've already got 45% of the portfolio in, and all these kind of, so there's all kind of pressures that are trying to make you put that money to work in the market. And at that point, the easy thing to do, the comfortable thing to do, is to say, fine, we're going to take that 45% cash and we're going to put it into what Alistair Mundy called market aware positions. So, we'll put it into kind of stuff that's not going to bounce around too much, that's probably going to more or less track the market, and then everybody's happy. But for us, it's really back to that kind of self-actualization point. Are you in it to make everybody else happy? Or are you in it because you really believe in something and you identify with it and you want to pursue it to the nth degree? And so we really took that other route. And I think, the people who stuck with us appreciate that moment as a sign that we want to do things the right way. And for people who are really interested in investing with this kind of strategy, that gives them comfort that we're not going to kind of style drift when it's comfortable to style drift. It is a tension in running the strategy within a fund that you have to maintain a certain number of holdings. You can't go all to cash, even if you were to feel like going all to cash. That is, the price that you pay for having a strategy in a fund structure. There are a lot of benefits of having the strategy in a fund structure, but that's one of the challenges.
So you've talked about being prepared to invest in the uninvestable, going, as David described it, you going out there deliberately looking for trouble. What's the most uncomfortable position you've initiated on in the time you've been running the fund?
We look for situations where other investors are uncomfortable, but actually when we come to take a position, we are always very comfortable in taking that position because we feel like we've done the work. We think we've seen something that other people haven't. And if we feel uncomfortable, then it's some kind of subconscious signal that there's something in there that we've kind of noticed maybe, but not paid enough attention to, that we need to go back and spend more time on. The real moment of discomfort comes later. That comes when we realize we were too early or we were wrong, where we realize that, it's the stuff you don't know that gets you into trouble. We missed something, or, initially at least, ultimately we're right, but we're fighting against the momentum in the short term, and you start to kind of question and double question kind of everything. So we often become uncomfortable in the positions over time, not always because we were wrong, but because we were wrong before we were right, if that makes sense.
Yeah.
But at the point at which we take them, we always feel a lot of conviction in those positions.
What's your process around cutting a position that isn't working?
So we review the investment thesis whenever there's any kind of relevant news flow. So we review the thesis, we review the fair value. It is the hardest thing, for me at least, cutting those losers. And it's the behavioural piece. And of course, that's how we're trying to make money, is through the behavioural piece. But of course, I'm human as well. I think having Anders working alongside me definitely helps, because he doesn't get invested from an emotional perspective or in the positions in the same way as I do, because ultimately I've made the investment decision. It's kind of on my head. And Anders is also, he doesn't have the same value disease that I have. He's a bit more agnostic when it comes to investment philosophy. And also, he's Swedish. I don't know if that helps, but he's very good at being pretty blunt, telling me in a gentle way that I should go and have a think about this one, or have a look at that one, or, have I been thinking about this properly, or are there some positions in the portfolio I need to go back and review? So I think that definitely helps. But it is the shoot the dog, an old boss of mine used to say. It is the hardest thing to do.
It does seem that perhaps because you're trying to remove emotion through process. I mean, your process is quite an edifice that you've built, as you've described it. Where do you see the evolution of the process? What are the things that you see room to evolve on over time?
You start it from a position where you think you know everything and you really know nothing. And your process kind of reflects that, I guess. And over time, you start to learn a few things, and you evolve your process to reflect what you've learned. Typically, I think the life cycle of the process involves kind of building it up and then kind of taking it down almost. The process is something that works in hand with intuition. And so the process is there to kind of keep you honest. It's there to provide a sense check against your intuition. But the process also develops in hand with your intuition, because it should always be informed and developed by what you've learned over time. So process and intuition kind of go hand in hand. Almost as you become better in terms of your judgment and skill, you kind of need less process. I think the best computer we have is a human brain. You just have to know how to use it correctly, and how to overcome your biases, and how to feed it with information the right way, and all these kind of things. When we started off with this process, we approached risk in a very quantitative way. We have a fair value. We've always had a fair value. We call it an approximate value, and we apply a standard deviation around it to remind ourselves that it is just a single point estimate in a range of approximate returns. But so we have a kind of quantified fair value, quantified upside, but we also quantified risk. And we ran through this kind of elaborate checklist and boiled risk down to a number. And our position sizing was a function of the upside and the quantitative risk. And so if a company fell into the high risk category, then you would need a higher amount of upside in order to take a full position. Whereas if it was in a lower risk category, you would only need a small amount of upside to take a full size position. And what we found is that actually trying to quantify risk in that way was far too simplistic, and it really tripped us up. It hindered us as much as it helped us, or more than it helped us. So we evolved the way we thought about risk from this quantitative checklist-based approach to more of a narrative approach. And we ended up with kind of transforming our initiation into a list of, it's about 95 different questions, mostly around kind of risk factors. And that fires up a different part of the brain, I think, and it allows you to see the interrelationship between different risk factors more clearly. And I think that's a much better way of evaluating risk than in this pure checklist-based approach. So that's kind of a little bit on the kind of evolution, some of the evolution that we've kind of taken in terms of our process. Part of the joy of the job is that it's continual learning process, not only learning about companies, but learning about yourself and learning about the skill and the art and the science of investment. I think areas we can definitely do better, first of all, on our screening of companies. So at the moment, we get some ideas from the screen, we get some ideas from the network. People call me up and send me a message or whatever. Have you had a look at this? I would like to be in a position where whenever anybody gives me a nudge about an idea, about a good idea, I can say, we already looked at it last week, because it's something that our screens had already brought to our attention. And I think that we need to move from a kind of screening as a periodic process more to a kind of a live dynamic push screen where ideas will kind of pop up the moment they become live and relevant rather than running through this kind of periodic process, which means you can often arrive at ideas late or.
Yeah, for sure. And the answers will look different for everyone and every investment style. As you mentioned, there are lots of ways to win in the market, but the fact that it's a never-ending process of evolution is the challenge and the joy.
Yeah, exactly.
You've given us a great explanation of the journey you've taken from setting Cape Wrath up to today and how your investment philosophy has been shaped and how you've developed your investment process. What are your ambitions for the fund?
My ambitions for the fund is to close it. So, we've got a relatively modest soft close at 100 million. I think once we close the fund, I can delete my LinkedIn, turn off my phone and retire to the library and pick stocks. That's the
So not close it in the sense that you don't want to give up on it, but close it to new investors.
That's correct. Yeah.
You see yourself as benefiting from this fund as being an investor in it more than managing it. You see yourself as just being allowed to hide yourself away even more and just get on doing the job of picking stocks.
Yeah, I think that's right. And I think your point about making money as an investor rather than managing the fund is absolutely a fair comment. I mean, if my motivation was making money out of managing the fund, I would have quit this a long time ago, because running a subscale asset management business is basically a very expensive hobby. And our fee, 30 basis point AMC, our fee structure really reflects the fact that it's about doing something I would be doing anyway and kind of opening the door for other people to come on the journey with me.
Adam, that's really been great. Very much enjoyed the conversation. Thanks so much for your time today. I look forward to following your future progress with great interest. And David, thanks
Jeremy. Thanks, David. It's been great talking to you.